Downtown Dubai was built on a promise: unlimited growth, luxury, and crowds that never faded. But in 2025, occupancy in its flagship hotels has plunged up to 20%, while discounts replace waiting lists and empty lobbies echo where fortunes were made. If a city designed for perpetual demand starts running on half capacity, what happens next? And how did the cracks first begin to show? In 2002, a new law opened Dubai's property market to foreign buyers for the first time. Freehold ownership, once unthinkable in the Gulf, triggered a flood of overseas capital. Developers raced to transform the desert with glass towers and artificial islands. Within 2 years, cranes dominated the skyline, financed by global investors eager for a stake in the next big thing. The Jebel Ali Free Zone, already a magnet for trade, expanded its reach, and trade volumes jumped by 20% in just 3 years. By 2005, construction began on the Burj Khalifa and Dubai Mall, projects designed to draw the world's attention and set new records. The Burj Khalifa, completed in 2010, rose above the city as the tallest structure ever built. Dubai Mall opened in 2008, offering more than 1,000 shops and an aquarium the size of a city block. These mega projects required enormous upfront investment and depended on a steady stream of tourists, shoppers, and residents to stay viable. Dubai's economic model rested on 3 pillars: tourism, real estate, and trade. Oil, once the region's mainstay, accounted for less than 5% of GDP by the 2010s. Instead, the city's growth relied on a relentless flow of visitors and investors. Expo 2020, delayed to 2021, brought record crowds and helped push international arrivals past 18 million by 2023. By this point, Dubai had become a city where spectacle was both the product and the business plan. None of this could have happened without a vast workforce. Over 90% of Dubai's labor force consisted of migrant workers who built and maintained the towers, malls, and hotels that defined the city's image. The model delivered speed and scale, but it also meant that every drop in demand threatened not just profits, but the livelihoods of hundreds of thousands. High fixed costs for security, utilities, and maintenance left little margin for error. When demand softened, the risks became impossible to ignore. Quarterly data from 2025 reveals a different rhythm in Dubai's downtown and Marina districts. Year over year, hotel occupancy slipped by 6 percentage points in the third quarter, dropping from 80% in 2024 to roughly 74%. While citywide averages remain robust, this is the sharpest decline reported since the pandemic recovery. Short-term rental platforms echo the pattern. Occupancy in tourist-heavy neighborhoods fell by 11% compared to the previous year, and average nightly rates on Airbnb and similar sites slid by 8%. Booking dashboards, usually guarded by hotel operators, now show a clear softening. Repeat visitation dropped from 42% to 31% in 2 years, and the average length of stay has shrunk from nearly 4 nights to just over 3 nights. Despite these signals, official visitor arrivals still climbed by nearly 5% in the first 10 months of the year. But the composition of guests is shifting. European and Indian arrivals, once the backbone of Dubai's luxury tourism, declined by 9% and 12%. Airlines have begun trimming capacity at Dubai International, citing sustained pullback in demand from core markets. For hotels in downtown, the response has been subtle but telling. More bundled packages, free room upgrades, and flexible cancellation policies, all aimed at filling rooms without slashing headline rates. Yet even with these tactics, some properties are operating at levels well below their break-even thresholds. While the city's skyline still gleams, the underlying numbers suggest a market recalibrating in real time, with operators watching dashboards as closely as they once watched construction cranes. A luxury hotel in downtown Dubai faces a simple equation. The lights must stay on, the pool must be cooled, and security guards must be on duty, whether rooms are full or empty. The general manager, reviewing the year's financials, points to a line item that rarely changes: fixed costs. Utilities, maintenance, and security alone can account for nearly half of all operating expenses, according to industry benchmarks. In a city where summer temperatures soar above 40 degrees Celsius, air conditioning runs around the clock, consuming up to 25% of the property's budget. Security and maintenance follow close behind, each taking another significant share. These costs do not shrink when guests stop coming. For most five-star hotels, the break-even point sits around 62% occupancy. Below that threshold, every empty room chips away at profit. The operations supervisor explains that even with creative promotions and bundled packages, filling rooms is no longer guaranteed. When occupancy falls to 60% or lower, as some downtown properties have quietly reported, the numbers no longer add up. The spa closes 2 days a week. The lounge offers limited hours. Staff schedules tighten, and routine upgrades like fresh paint or new linens are postponed. The hotel's monthly profit and loss tells the story in stark numbers. Fixed costs, utilities, security, and essential maintenance remain constant, while variable costs like food and beverage shrink with fewer guests. Yet the savings from reduced service barely offset the losses. The general manager admits that at 50 to 60% occupancy, the property is running at a loss, even before considering debt service or franchise fees. For now, the hotel remains open, but the balance sheet is under strain. Every decision is a trade-off between maintaining the brand's promise and keeping the doors open. A housekeeper named Lila clocks in at dawn. Her shift is cut from 8 hours to 6. The hotel once ran 3 teams per day. Now only 2 remain. Management posts the new schedule on a faded bulletin board: 25% fewer shifts than last spring. Lila's take-home pay drops, just as her family back home faces rising food prices. She is not alone. Colleagues whisper about contracts not being renewed and overtime vanishing. Some have already left, hoping to find steadier work in Sharjah or Qatar. In the guest corridors, subtle changes go unnoticed by some, but not by all. Fresh towels arrive late. The breakfast buffet, once a lavish spread, is trimmed to essentials. The pool closes 2 afternoons a week for maintenance. A family from Germany finds the spa shuttered, and their review mentions disappointment and a sense that the hotel is not what it used to be. On popular booking sites, negative reviews about slow service and unresponsive staff begin to cluster. The trend is clear. As hours are cut, so is the quality of the experience. Managers face impossible choices. To keep the lights on, they must reduce headcount and close facilities. But every cut risks eroding the hotel's reputation. For Lila, the stakes are personal. Fewer shifts mean less money sent home, and the fear that her job could disappear entirely. For guests, the city's promise of seamless luxury slips, one missed detail at a time. The impact ripples outward, from worker to guest, from review to reputation, casting a shadow over the city's polished image. A mall retailer in downtown watches foot traffic dwindle, with sales slipping just as operating costs remain fixed. Fewer shoppers means less turnover for luxury brands that once thrived on a steady stream of tourists and residents. The numbers tell a quiet story. Retail sales across major malls have softened, and conversations with developers reveal a new mood of caution. An agent points out a sharp drop in new construction permits filed with the municipality, activity down nearly 1/3 from last year. Developers are holding back on launches, waiting to see if demand will rebound. The slowdown in retail and construction ripples outward, touching suppliers, service providers, and even the city's own tax revenues. For a city built on constant motion, hesitation spreads quickly and the risk grows. Luxury travelers now weigh Dubai against rivals like Abu Dhabi, Riyadh, Istanbul, and the Maldives, all offering similar experiences, sometimes at lower prices. Airfares into Dubai have climbed 17% since 2023, making alternatives even more attractive. Policymakers have responded by expanding visa schemes and launching long-stay incentives, hoping to slow the outflow. An economist notes that Dubai's edge depends on value for money, not just spectacle. The Department of Tourism points to 3 possible futures: a quick rebound if occupancy returns above 75%, a managed adjustment with more long-stay visitors, or a prolonged slowdown if new projects stall and events shrink. Each scenario now has its own benchmark, and the next 6 months will reveal which path Dubai takes. Dubai's future now depends on its ability to adapt, not just impress. As global travel shifts and competitors rise, the city faces a test no skyline can answer alone. Today, resilience matters more than spectacle, and the world is watching what Dubai does next. Share your thoughts below.